All right, joining me now, Simplify Asset Management Portfolio Manager, also Chief Strategist, Mike Green. Mike, you say that the focus of this symposium does suggest the Fed is confused why interest rate policy hasn't had a more pronounced impact on the economy. Why do you think it hasn't?
Well, I think that there's two separate components there. One is simply they panicked when they cut rates in 2019. They panicked when they cut them even further in 2020. The second one was understandable. And then they panicked once they realized that they were too late to hiking rates. They've hiked them far too far, far too fast. That meant that we couldn't even see the impact of this roll through the economy before they got to levels that candidly are creating tremendous amounts of business stress. We've seen bankruptcies surge. We've seen delinquencies begin to surge very rapidly, particularly for the younger generation that is in that capital accumulation mode. These are just the wrong levels of interest rates for the majority of individuals in the economy, even as many benefit from it. And so I think you're seeing the regional feds push back with increasing, I might even use the word vitriol, against the idea that the policy is currently set at the right level.
So with that in mind, all these panic moves, I thought, listen, I'm not an economist, but I thought when they started hiking rates, when they only went 25, I felt they should have gone 50, even more, and only because they articulated a sense of urgency, but the action didn't seem to match that. Where are you now with respect to how do they begin this rate cutting cycle with the backdrop of the pain that you just described?
Well, I think the unfortunate part is that we still aren't feeling the pain where it matters from Fed policy standpoints. And so if I look at the equity markets, they're near all-time highs. If I look at credit markets, credit spreads are quite tight. Part of that is the high level of interest rates. So there's a tension that emerges there. But I would argue that the Fed doesn't feel the urgency that many members of our society, with the rising unemployment rates that you highlighted, for example, or the QCW expected this week, the quarterly census, unemployment and wages expected to show that nearly 1 million jobs that we thought were created in 2023 were not actually created, right? So the data looks significantly worse if you dig under the headline numbers. But in many situations, that just doesn't matter because the street increasingly trades off of headline news reports. Those job revisions that we've seen over and over again, they don't matter.
They don't. I mean, to me, it's nuts because the same economists who come in on the days that these numbers are reported and say, oh, it was fantastic, come in the day after they're revised, and they still talk, hey, it's fantastic. Speaking of which, a few months ago, it seems like economists in general had this mass epiphany about how great this mass migration is or has been for our economy, holding down wages. Just your thoughts on this as the job picture changes particularly and we still have high migration levels.
Well, so there are some questions about how high those migration levels are, but the real core of the issue there is it migration that actually fits the needs of what the United States needs? Does it create its own risks when we can't control our borders? We know the answer to that is yes. We know that this is not an optimal immigration policy by any stretch of the imagination. And as a result, it's not going to have the positive impact that it otherwise might were we importing immigrants who met our skill needs, who met the objectives that we're trying to achieve as a country. And that's one of the biggest challenges is I think that we've lost the ability to have a real conversation about what are we trying to accomplish.
Yeah, in this political era. Hey, I got 30 seconds. Yesterday, we discussed that National Bureau of Economic research report that was out in 2007, and it showed that housing was by far the best early warning sign of oncoming recession. And it feels like every time we get a CPI report, everyone debates housing. It's supposed to be a lagging indicator that the data is all wrong, but it hasn't really adjusted to the degree we were told it would. Are there implications with housing that the Powell Fed should be considering?
Well, I think absolutely. And I'd mentioned the regional Fed starting to revolt, right? So the Minneapolis Fed just came out with a fantastic paper that actually hits on this issue of housing, highlighting that the long lead times associated with the housing market suggests that the Fed never should have been targeting housing as one of the key components of the inflationary story. The simple reality is if you hike interest rates, you lower bond prices. That means that those who bought their homes with mortgages at 2.75% are sitting with homes that are up a little bit in value, but the mortgages that they took out are trading at 50 cents on the dollar. And so for them to turn around and give up those mortgages either through refinancing or relocating is an incredibly uneconomic outcome. that candidly was created by Fed policy targeting something that it probably should not have been hitting on at all.
Mike, great stuff. Always appreciate our conversations. Thank you, man.
Thank you, Charles.